Okay, class, we are going to look at the last part of Chapter 7, that is notes receivable. What happens a lot of times is that if a company or a person cannot pay their debts, they'll extend a promissory note. This is a written promise to pay an amount by a specific time. These notes are always interest-bearing. They have a specific time frame. So these two factors are different than credit because credit only earns interest if somebody doesn't pay the balance. Promissory notes, you earn interest no matter what. They do have a specific time frame. Credit card balance could go on forever. As long as you pay that minimum monthly, you are going to continue to pay, and there is no specific time frame for when you have to pay it off. Promissory notes are often accepted in lieu of an accounts receivable because they have a large balance. And the one difference from this, as I pointed out, is that interest will be earned with these things. Okay, how do you calculate interest? It's PIT, principal times interest times time. We always assume 360 days per year for the time. So if it was 1 month, you'd go 30 over 360, or 1/12. The interest rates are always annual unless stated otherwise, and that's how you figure the interest. So if it was a $1,000 loan at 10% times 30 days, you would simply go 1,000 times 0.10 times 30 divided by 360 would be your time. Okay, and then you'd come up with the interest earned, which is also the interest paid by the borrower. Okay, journal entries for notes receivable. The JVs, by the way, comes from journal vouchers, what they used to use long before electronic accounting. So understand when I say JV, it means just journal entry. Okay, when the note is issued, what happens is the person who lends it, or the lender, takes out they have an asset called note receivable, very much like an account receivable, except it is an interest-bearing note. So it's different in that sense. Clearly, you would have some sales that was converted to a note receivable, or you would have sales volume, and this is just the loan on, say, like a car or something big. Okay, so that's your journal entry for when the note is first issued. Okay, notice here that this was a note in the journal entry saying we accepted a 90-day 8% note for $10,000 for sales merchandise on February 1st. All right, so I made $10,000 in sales. Instead of an account receivable, we took out a note receivable. Okay, what does this look like? When you pay it 90 days later, you have, obviously, you earn some cash plus the interest. You pay down the receivable, and how did we get that interest earned? It's $200. Well, that came from, here, I'll go back. It is a $10,000 note. Okay, let me get there. $10,000 note times 8%, so that would be 1% of 10,000 would be 100, so 8% of that would be 800, but it's only for 90 days, so it's only for 90 divided by 360, 1/4. 1/4 of 800 is 200. So my principal times interest times time got me $200 in interest earned, or interest paid by the borrower. So here's that journal entry again. Interest earned was $200. Debits must equal credits, so 10-2 is the cash they actually collected after 90 days. The note payable goes down to 0 with this credit, and the interest earned is a revenue account that goes up with a credit of 200. Okay, what if it was unpaid? What if the person didn't pay you? Well, then you could kick it back into an accounts receivable. You now have a legal right to collect the original principal plus the interest, but it's no longer a note receivable. Instead of cash, you just got the legal right to go collect it. Now, just because you have the legal right to go collect it does not mean that you will get it. As we learned from bad debt expense in the rest of this chapter, the legal right to go earn the money or go collect the money does not necessarily mean that you get it. Okay, so this is what happens with those: is when they're not paid, you actually trigger an account receivable there. Okay, sometimes companies don't want to bother going to get these things, and we'll talk about that next slide. Okay, so adjusting journal entry for the interest earned at end of accounting period. That's what this means, end of the accounting period. What happens is, suppose that the quarter ended on February 28th and we had a couple months there. Okay, the way I would do this is I'd have to figure out the total days that happened from January 1st through February 28th. So of that $200, well, let's go back. Hold on. The loan was issued, or the note receivable was issued on February 1st. So it was only 28 days, really I think 27 days. So if we took 28 days out of that 200, or roughly 1/3, it's going to be a fraction of it. Okay, so I took PIT, principal times interest times time, and this would be the interest earned in just the first month. It should be roughly 1/3 of the $200 interest. Okay, February is a short month, so really it should be 27 days, so 27 times 10,000 times 8% should have given me right around $62. And if I'm off by a day, that's fine. I might have taken 28 days here, but either way, it's about a third. Okay, a third of 200 is going to be just under 70. Well, we're just under 70. Okay, at maturity date, what happens here? Well, maturity means at the end of the 3-month loan period, the full principal is paid back. You collect all of the cash. Notice there's no cash collected up here. This was just an accrual, a adjusting journal entry at the end of February, because that's when our accounting period ended. At the end of the loan date, 30 days after it was extended, we collect the full amount, cash plus interest. We actually write down the note receivable, and actually here, watch what happens here is this interest receivable now becomes collected. Okay, so that goes down. Interest receivable, that's an asset account, goes up with a debit. Here, when it's paid off, goes down with a credit. And what's missing? 10,000, 10,200, 62. It looks like I'm missing the rest of that $200 in interest, which I think should be 138. Well, that's interest earned the last 2 months, from March 1st through the end of April when the loan matures. Okay, so that interest right there should be calculated $10,000 times 8% times, it looks like about 61 days. 31 days in March, 30 days in April, and that should give me that value there. So 10,000 principal times interest times time. I think 61 days it gets you about 138. Either way, these two have to add up to 200, and so some of the interest was earned in this period, as it has to be. The remaining dollars that make up the $200 in interest was earned in the second accounting period, which included March and April. Okay, hope that makes sense. That's how these things go. Okay. One last slide here is that sometimes notes are sold and they're actually dumped to someone else. So what happens is companies just want to generate cash. They don't want to bother collecting them. We don't want to be exposed to bad debts. We'll take all the accounts receivable and we'll say, you know what, you guys go collect this. We'll sell it to you and we'll discount it at 5%. In other words, for every $100 in accounts receivable, we'll accept $95 cash right now, and you can go out there and collection agency, you go collect every penny of it that you can, and we'll just take 5% less just because we don't want to deal with it. So what happens here is if we had a $40,000 note or a $40,000 account receivable, we're going to say that we'll sell it off at 5%. Well, 10% would be 4,000, so 5% would be half of that, 2,000. 40,000 minus 2,000 gives me 38,000. So we'll collect $38,000 cash. We will write down the full 40,000 of this receivable, whether it's a note receivable or an account receivable, and we'll just charge ourselves this expense of factoring fee expense. So we'll take $38,000 out of the 40,000 we had the legal right to go collect, just because we don't want to deal with it. And so I think you have a homework problem like this, and that's how that works. And there you go, selling receivables. Okay, that's the last lecture in this chapter, so there you go.